Hi everyone, it's Saraan here. Today we'll be going through the results of the Broke to No Joke Challenge and see how much money I earned or lost from this challenge. Now, let's cue the intro. Hi everyone, welcome back to my channel, Investing with Saraan. Today we have an important video for our new series. I decided to provide you all a short video on the current standing of this portfolio. But before that, I want to remind you all the reasons for this challenge for any new watchers of this channel. The main purpose of this series is to show how a university student like myself, without a lot of money, can build up a nice growth portfolio with a small amount. I also want to ask you all to drop a like on this video and subscribe if you're a new viewer. We're slowly growing and improving our audience, and I would love to hit the 400 subscriber mark within the next few months. With that information, let's see how our 6 stocks have done until 2021. The first stock that we added to our small account growth challenge portfolio is Drone Delivery Canada Corp. As a recap, this stock has a business focused on their drone products and services. They not only develop and sell the products in their company, they also sell the license and the software along with it. Drone Delivery Canada is a publicly traded, as mentioned in the beginning of the video. It is a disruptive company that is pioneering technology that is focused on designing, developing, and implementing commercially viable drone-based logistics systems for government, commercial, industrial, and retail customers globally. Currently, at the time of making this video, this stock was valued at 77 cents. I bought the stock at $1.04 Canadian and bought 72 shares. This gives me a loss of 14.29%. This is unfortunate as growth stocks have been having a bad month, with many people switching to value and dividend stocks. Unfortunately, this did not live up to its reputation and did not gain more in market appreciation as I wanted to for this challenge. The second stock that we added to our small account growth challenge portfolio is CloudMD Software and Services Inc. As a recap, this stock is a telehealth company based in Vancouver, Canada. They are a rapidly growing technology company that focuses on digitizing the delivery of healthcare by providing patients access to all points of their care from their phone, tablet, desktop, computer. They have developed proprietary technology that delivers quality healthcare through the combination of connected primary clinics, telemedicine, and artificial intelligence. CloudMD's team-based whole-person approach to healthcare aims to engage patients and empower doctors while connecting the entire ecosystem and providing longitudinal care. Currently, this stock is valued at $1.13. I bought this stock at $1.62 Canadian and bought 36 shares of this. This gives me a loss of 25.84%. This company was destined to grow as it had hit highs 3 months ago of $1.96 Canadian with the 8% gain. I was planning to buy more as the market loss was more than 10%, but now that the challenge is over, unfortunately this did not live up to the reputation and we did not gain more in market appreciation. The third stock that we added to our small account growth challenge portfolio was H20 Innovation Inc. As a recap, this stock, H20 Innovation, explained by their name, is a company that innovates the simple element known to us as water. H20 Innovation is a complete water solutions company focused on providing the best in-class technologies and services to our customers. Currently, this stock is valued at $2.59 when I made this video, and I bought the stock at $2.29 and bought 6 shares of it. This gives me a loss of 13.10%, and unfortunately this hasn't come back from its highest peak in early 2021 with a 21% increase. Unfortunately, this lived up to the reputation and gained more in market appreciation. It's one of the only stocks that actually gave me appreciation with this challenge. The fourth stock is WellHealth Technologies Corporation. It's one of the leading providers of telehealth across Canada. WellHealth's telehealth platform connects patients to physicians through video, phone, secure messaging. WellHealth offers Canadians an alternative to lengthy waiting rooms, waiting visits, and provides better access to care for patients who are limited in their patients' travel and mobility. Patients can now schedule an appointment online and connect directly with their physician via their phone, tablet, and computer without having the need to download or configure any confusing app. WellHealth offers 2 telehealth and virtual care platforms, telehealth and Virtual Clinic Plus, which together supports over 2,800 physicians and 200,000 virtual care visits in the past 3 months. I bought the stock at $6.61 Canadian and bought 9 shares of it. After 3 months, this stock is valued at $4.88, which is really great. It's currently giving me a big dip of 18.18%, and unfortunately this did not live up to its reputation and did not gain more in market appreciation, which is unfortunate for this challenge. My fifth stock is Green Lane Renewables. Greenlane is cleaning up two of the largest and most difficult to decarbonize sectors of the global energy system, and this includes the natural gas grid and the transportation sector. They are a leading global provider of biogas upgrading systems, as Greenlane's solutions create clean, low-carbon renewable gas suitable for injection into the natural gas grid and for the direct use of vehicle fuel. Their biogas upgrading plants, marketed and sold under the Greenlane Biogas brand, remove impurities and separate carbon dioxide from biomethane and the raw biogas created from organic waste at landfills, wastewater treatment plants, and farms and food waste facilities. Unfortunately, this did not live up to its reputation and did not gain more market appreciation. The most recent stock was Transat AT Inc. Transat AT is a leading integrated international tourism company specializing in holiday travel. It offers vacation packages, hotel stays, and air travel under the Transat and Air Transat brands to 60 destinations in more than 25 countries in the Americas and Europe. Transat is firmly committed to sustainable tourism development as reflected in their multiple corporate responsibility initiatives over the past 12 years. It was awarded Travel Life certification in 2018, and based in Montreal, the company has 5,000 employees so far. Currently, the stock is valued at $3.95. I bought the stock at $5.15 Canadian and bought 10 shares of it. This gives me a loss of 23.33%. Unfortunately, like many of the stocks on this portfolio, this did not live up to its reputation and did not gain more in market appreciation. After reviewing the stocks that I bought so far in my small account growth challenge, we now have to calculate the percentage of market gain. Using the Wealthsimple Trade app to input the information, we're able to see that for this challenge, we had a loss of 21.42%. Now we'll be looking at the things that we learned within this challenge. After finding out the overall loss of this small account growth challenge, I'll outline the key things that I factored into the loss and the things that I've learned in this challenge. One thing to note from this challenge is the continued shift within the stock market. In early 2021, many growth stocks were at all-time highs with low inflation rates, motivating investors to put more money into the stock market. As the year progressed, these growth stocks faced the fear of inflation, which caused investors to start selling their stocks, which made room for inflation. Some investors also believed that the stock market is overvalued, which made them fearful in continuously investing into the stock market. With this challenge, I've also learned the importance of dollar cost averaging and importance of financial reports. Dollar cost averaging is essential for a small account growth challenge with volatile stocks. Within this investing strategy, people invest a fixed amount at a regular intervals, regardless of market performance. The term dollar cost averaging refers to what happens when you invest a fixed amount at a regular interval regardless of market performance. When markets are down, you automatically take advantage of the opportunity to buy more units of your investment at a lower price. When the markets are doing well, the money you've already invested is benefiting from that performance. The discipline of paying yourself first puts the power of dollar cost averaging to work for you and can limit the impact of emotional investing during periods of market volatility. The importance of referring to financial reports was really important in this growth challenge. Financial statements are often referred to a company's report card. They provide regular information of the company's performance, financial position, and company cash flow situation. Publicly traded companies are required to publish their quarterly and annual financial statements. Understanding the information contained in these financial statements is very important in making informed decisions about your investment. That's especially true within this challenge. Stocks that we had were more volatile than normal blue chip stocks, and this means that their financial really impacted how well they did and how much their price actually moved, whether it was down or up. Now that we've looked at the stock's results and the things that we learned, there's just one more aspect of this challenge that I'll focus on. The aspect focuses on the next steps. I've decided that I will be selling these stocks for tax harvesting. For those who don't know what tax harvesting is, I'll give you a brief explanation. Tax loss harvesting is also known as tax loss selling. Usually, this strategy is implemented near the end of the calendar year, but can happen any time during the tax year. With tax loss harvesting, an investment that has an unrealized loss is sold, allowing a credit against any realized gains that occurred in the portfolio. The asset is then replaced with a similar asset to retain the portfolio's asset allocation, expected risk, and return levels. Tax loss harvesting is the most critical tool for reducing taxes. Although tax loss harvesting cannot restore an investor's previous position, it can lessen the severity of the loss. In my portfolio, for example, a loss in the value of Alibaba could be sold to offset the increase in the price of Apple, thus eliminating the capital gains of tax liability of Apple. this will only be done in the taxable accounts. For example, this will apply for TFSAs in Canada or Roth IRAs in the US. For this account, I sold all my stocks and transferred the money into my TFSA where I can use it to help grow my dividend growth portfolio to $25,000. If you guys want to know more about it, I provide an update video every week for those who want to join my dividend journey to $1,000 in monthly dividends. That being said, I hope you enjoyed this concluding video to this series. Tax loss harvesting is a great strategy for those who are wanting to offset their losses with tax advantage. But with that information, make sure you punch that subscribe button down below and drop a like. Remember to click that notification bell so you don't miss any of my videos. It's been Saraan, and join me on my next video. Bye for now.